Hey, hello, and welcome everybody to today's workshop. I hope you're doing very well, having a beautiful Sunday. Hopefully, you're having some decent weather. We're having some great weather today out in California. It doesn't seem like it's wintertime. We were looking up over in Tennessee just a couple days ago, my wife and I, and it was down in the 40s, I believe, or low 50s, and somewhere we're going to think about visiting in the spring, but we're really enjoying the California weather today. So I hope you're having a great Sunday. You're relaxing a little bit, and you're ready to learn a little bit more about the topic of Roth conversions. This has been such a hot topic lately. There's been a lot of questions about it. So I thought, we'd take a couple weeks and just dive into the subject. If you're new here, my name is Jason Hamilton. I'm a certified financial planner and the founder of Keep It Simple Financial Planning. So I'd love to introduce myself. And every Sunday, right around this time, we're going to be bringing you a live educational workshop. I probably am going to take a couple weeks off around the Christmas season. I hope you understand that. But generally, about 50 weeks or so a year, I'm doing some sort of some workshops or some education. So if you haven't yet, please, like our page, follow the page so that you can be notified when we're going to be doing these live workshops. We try to make them valuable, pertinent, and have a really good information that you can actually use when it comes to planning for your retirement. So today, we're going to continue our conversation around Roth conversions, as I mentioned, and we're going to be talking about the state tax implications of considering a Roth conversion. So in simple terms, what does that mean? Well, I'm sure we all know that we have federal taxation, right? So we have our federal tax brackets. And then we have the majority of states, you could say, that have some sort of state tax implication when it comes to earning income, where you're going to have to pay some sort of income tax. There are quite a few states that do not. I believe it's Florida, Texas, Tennessee. What am I missing here? Is it South Dakota, Washington State, and I think there's one more. But there's a few states that do not have any state tax, but there definitely are a majority that do. But there's also some special situations for, I believe, 12 or 13 states that you may want to take into account when you're looking at this potential this tax planning item. So we're going to walk through some of those today. I'm going to give you some examples, and hopefully you walk away today with a better idea of what your game plan should be when it comes to planning your tax planning strategy. And of course, as always, if you need help with your tax planning strategy, if you're considering Roth conversions and you want some professional guidance, you can always go to our website, keepitsimplefinancial.com, and schedule a call to speak with us. So we'd love to chat with you. So we're just going to jump right in today and talk about our Roth conversions. Hey, Barbara, how you doing? Lucky you're in New York. Yes, we'd love to come visit, but I think it's a little too cold for us right now. We'll have to wait till it lightens up just a little bit there. So let's see here. All right. So we're going to jump, like I said, right in to our, give me 1 second, actually, I'm sorry. Let me fix one thing here. Let's see, give me just a second. You got to love when you do these lives. There's always something to be thinking about. Okay, there we go. We should be good to go now. All right. There we go. All right. So today we're going to talk about the state tax implications of Roth conversion. So hopefully this is something that you may not have done all the research on, and hopefully I can bring you some insights and help you get a little bit better. Oh, it's not too cold yet in New York, Barbara. It's great to hear. All right. So as always, before we jump in, I have to let you know that this is for educational purposes. This is not meant to be individualized tax, financial, legal advice of any sort. It is here to educate you and make you more aware of things that I think you should be aware of when it comes to planning for retirement, but it doesn't mean this is all the answers. You should definitely seek out a professional guidance to help you with this decision, especially around anything with tax planning. These are very, very technical items sometimes. So let's talk about this here, okay? So we put out a survey, and we had about 43 people want to learn more about Roth conversions. So it's safe to say that Roth conversions have been a very popular topic recently, and for good reason. Since the Secure Act has come in place, which is in 2020, there's been a requirement that most non-spouse beneficiaries must fully distribute their inherited IRAs within a 10-year time frame. And so that's a big deal, okay? So think about it for a second. If you have a non-spouse beneficiary, so this is probably your children or whoever else may be inheriting your IRA, we've gone from being able to use a lifetime distribution schedule. So if you've heard of a RMD, or required minimum distribution, when you inherit an IRA, there's generally a lifetime table that you follow. prior to 2020, I should say, that you could just follow and take a portion out of your IRA each year. And generally that portion's anywhere from 2.5% to 4%, somewhere in that range to start. But now with the new Secure Act, that has changed. Okay, so anytime a non-spouse beneficiary, unless they meet one of the exemptions, which would be somebody who might be disabled or some other small circumstances. But outside of that, you got 10 years. Okay, so 10 years to get the money out of this IRA. And if you're pass on like a big IRA, maybe it's $1 million or a couple $1 million, and imagine having that distributed over 10 years to even 1 or 2 children and adding $1 million of income to them over that course of 10 years. That could be quite costly, and you could be just throwing a whole lot of money that you did a wonderful job of saving, investing, not spending in retirement that just gets given away to taxes in the future. Okay. And some of you are positive on taxes where you think taxes are going to stay low and they'll stay low going forward. Or you might be negative on taxes like myself and think that taxes are most likely going to go up in the future. So I personally think that we're going to be paying more taxes, not less. But right now, we have relatively low federal income tax rates, and these are in effect and can make conversions less costly now, and potentially a better strategy than converting directly to Roth accounts while working. Okay, so we've talked about this before, but think about it like this. If you are working and you're earning the highest amount of income you've probably ever earned, if you're in your 50s or 60s, you're probably in your peak earning years. And let's say you're earning, $100,000 plus. Well, if you decide to contribute directly to a Roth account today through your Roth 401k or Roth IRA, well, you're going to be paying at essentially your top tax rate. Okay, so you're going to be paying at your highest tax bracket right off the top. But if we consider looking at conversions in either a low income year or a post-retirement where your income is basically zero, and we're starting from the bottom up, remember that we have our 0% tax bracket, which is also known as our exclusion. So right now, I believe it's $12,400 for singles and $12,800 for married folks. Excuse me, $24,800 for married folks. And so you get to essentially convert that much at zero. Then you're going to have your 10% bracket, which is just under $10,000 for singles and just under $20,000 for joint filers. And so you can convert an extra $10,000 to $20,000 there and pay no more than 10% of that amount in taxes federally. And then from there, you got your 12% bracket, which goes up to about $40,000 single and about $80,000 joint. Okay, so you can go all the way up to close to $100,000 of a conversion and still stay in the 12% bracket if you have no other income sources. Whereas if you're working today and you're contributing to Roth, you're going to pay whatever your top tax bracket is. So if you're making $80,000 plus, it's very safe to say you might be paying at 22% on that contribution. So looking at conversions post-retirement may be a better way to plan your tax planning and to get you in a better spot later for retirement. And on top of that, I think really looking at the best time in the year to do the conversion is actually very important as well. So we're getting really at the end of the year here. So if you're going to be looking at this type of strategy, you got a couple weeks left. We've been talking about this for weeks already. We've been planning for this with our clients for the last quarter and some even early in the year. But since the 2017 Tax Cut and Jobs Act, it's ended the opportunity to undo Roth conversions. So you used to be able to undo them if you did it early in the year. Now you can no longer do that. That was called recharacterization. That is gone. So now we believe the best time to do Roth conversions is late in the year when precise planning is most likely. Okay, but all that said, there's been an overlooked factor which not a lot of people think about, which is the state tax effect on Roth conversions. Okay, so there are a few things here that we want to be looking at. Okay, there's going to be considerations when it comes to state taxes. And there's also going to be considerations when it comes to state estate or inheritance taxes. So we're going to focus today mostly on the state tax portion. The inheritance tax is a whole nother rabbit hole to go down. But I think most importantly for those that are pre-retirement or early in retirement or going into retirement, sometime soon, this is most important because you're not really worried about inheritance at this point. That's kind of more later down the road. So that's what we decided to focus on, for today. All right, so we're going to talk about the impact of income taxes. Okay, for income tax purposes, when it comes to states, we group states into 3 categories. Okay, we have states with no income taxes, we have states with income taxes, and we have states with income taxes plus special rules. Okay, this is where that special rules is where it gets a little tricky. I'm going to cover a few of those at the end, but there's actually a lot of special rules depending on which state you are residing in or plan to reside in. So one thing I do want to mention, though, is these special rules can make a meaningful difference, especially if you're thinking about moving to another state. So we're going to go through some examples here of thinking about moving to another state now or later in retirement, and how to think about when to do that particular conversion. And as always, if you have questions along the way, please go ahead and put those in the chat, and I'll do my best to get to those before the end. Okay. So we're going to talk here about Linda. Okay. So in example 1, Linda is a Florida resident and who is currently facing no state income taxes. Beautiful. So in this case, we do not need to be concerned about state tax on a Roth conversion if Linda has no relocation plans, right? So that is a wonderful thing. If you're in a no tax state and you're not planning to move to a no tax state or a state that has tax, then we don't have to worry about this in our considerations. Beautiful. John's situation gets a little bit more important to consider state tax. John lives in North Carolina and he plans to stay there, so he's not planning to move. He'll be facing a 5.25% state income tax regardless of when he converts his IRA to Roth. So in his case, again, we're just going to include this in the calculation and see what makes the most sense for him. But we know we're going to have to add in a 5.25% state income tax regardless of when we're converting. So this is, for John here, living in North Carolina, going to be something we want to consider. Okay. There are 13 states with special rules that are designed to attract retirees or enticing them to move there, including 12 with exclusions for IRA income. So if you either live in or thinking of moving to one of these states, we should consider how Roth conversions will be affected. Okay, so we're going to talk about example 3, Pamela. So Pamela lives in Pennsylvania, which has an unlimited exclusion for all retirement plan income, including IRA distributions with no limit. So this gets really interesting. So we want to, if we're looking at Pamela's situation, we would highly want to consider doing all her Roth conversions or partial conversions before she moves to any other state, because we can basically exclude all IRA distributions. So that's a beautiful thing when looking at the state of Pennsylvania. So not every state with special rules for retirement income is as generous as Pennsylvania. Some other states place limits on the amount of IRA income they exclude from tax, or the limits may depend on the taxpayer's age or the amount distributed, or both. Okay. So for example, I don't think I've just written down here. Yeah, so for example, clients living in Mississippi have the same unlimited exclusion as Pennsylvania, but only if they're at least age 59 and a half. So Pennsylvania doesn't have an age consideration, but Mississippi does. Some other states, retirement income exclusions are based on the account owner's birth year, which is like Michigan, or the funding source for the IRA, which is like Hawaii. So these are all special rules. And, as an advisor, really understanding how they work, or working with somebody that understands how they work to trim that state tax liability by planning when and where to execute the Roth conversions can have a lot of added value, to your bottom line. Okay. So now we're going to talk about a matter of timing the Roth conversion. So sometimes our clients move from high tax areas to states where there are no income taxes. So that can be a beautiful thing when it comes to planning for Roth conversions. And in that case, we might want to wait until they complete their move. So in example 4 here, Bill's going to be looking to move from New York to Florida. Okay. So for those of you, you Barbara there in New York, we got some pretty high state taxes. Not quite as bad as California, but definitely not great. Okay. So from a state tax perspective, we're going to suggest that Doug waits to do his Roth conversions till after he moves, because New York has steep income taxes and California has none. And we've also seen the reverse, where the individual may move from an income tax friendly state to a state with higher taxes, and that could be a possibility. So that's something we want to be aware of. If you're going to be moving from an income tax friendly state to a state with higher taxes, and this is where it gets a little bit tricky, because sometimes maybe buying a property or the home you own in your state, maybe you're in a state that has low or no income tax, but you're going to move to another state that has higher income tax, but your housing expenses are going to go down. There's a lot of considerations when it comes to mapping out a retirement plan. So this is why we're bringing these things up here. Okay. So let's talk about example 5. Let's talk about Erin. So Erin is thinking about trading in the East Coast. So she's going to move from Georgia to the West Coast over in Oregon. But she found out that Oregon's income taxes are higher than Georgia's. Okay, so that is something where we really want to be thinking about what to do based on her individual scenario. So in her scenario, it might make sense for Erin to convert her traditional IRA to a Roth before moving to high tax Oregon, and in that case, paying the lower state taxes in Georgia, right? So these are things that are going to be on a case-by-case basis, and you really want to be thinking about your overall comprehensive strategy when it comes to making this decision. And I also want to mention that Georgia is one of those special rule states I mentioned that, that decision would become even more compelling if Erin is age 62 or older before moving and can utilize the exclusion. Okay. So just some final thoughts here on this particular subject before we go over to some examples of the different states is that higher or lower tax, all states are likely to get their piece of the residence pie one way or another. So, we really want to be thinking about what is the overall long-term plan? How are we going to be living our life in retirement after planning? Are we going to be moving? Are we going to be staying where we're at? And then bringing these facts into the overall strategy is going to be important as we consider what your strategy should be when it comes to planning for Roth conversions. Okay, so I don't see any questions here, so I'm hoping this made sense. Oh, and Mary says Massachusetts, also known as Taxachusetts. Okay, I'm in Taxifornia, so again, neither of us are in great places from a tax situation. But I have this something here I'd like to share with you, and there's some things to consider with some of these states, right? So really want to be looking at your state. So if you're in Alabama, for example, your top income tax rate is 5%, but you have unlimited exclusions for pension income from a defined benefit plan, but not for IRA distributions. So there's a lot of little tricky things here, okay? Arkansas, the top tax rate is 6.6%, but up to $6,000 in retirement plan benefits, including IRAs, if you're 59 and a half or older, become exemption there. So there's a lot of little things here as you can see state to state. Let's see if we have let's look at Massachusetts since that was mentioned. So Massachusetts, really we got to be thinking about just your 5% flat income tax rate, not a big deal there. There is a $1 million exemption, and then after that, the estate tax is between 0.8 and 16%. So that can be quite ugly if that is the case. My state here of California, oh my goodness, look at this. Top tax rate, 13.3%, and they're trying to get it to 16.3, okay? Insane, okay? I think a lot of people are leaving California. You've heard this. It's all true. A lot of people are thinking about moving. We're considering it, but at the same time, I want to fight because I do like the weather here, but man, it's just getting a little bit crazy. Hawaii, top income tax rate, 11%, but they have unlimited exclusion for defined benefit plans. Some 401k and IRA withdrawals can be excluded if the funds are rolled over from a plan that would have been excluded, okay? So this is, again, a little bit tricky. So all these states here, as I'm showing you, there's a lot of little rules here, state to state. So my main point of this is that you really want to make sure that you are going through all the rules, all the considerations, your overall plan, whether you're thinking about staying in your current state or you're thinking about leaving to another state. All these things are going to come into play when it comes to looking at considering Roth conversion. What I don't want to do is overwhelm you, okay? There are some beautiful tools. As advisors, we have beautiful tools that help us figure these things out, and we can help you out with that. But it's not just as simple as, should I do a conversion up to the 12% bracket or not? There's really a lot of factors that are being built in. And for those of you that have, savings of $400,000, $500,000, $1 million, $2 million, there could be 6 figures or more of tax-adjusted wealth that could be on the table by getting this right. So I really want you to consider your overall strategy. Bring in a professional. We would love to help you out with that, but at least bring in a professional that is qualified. We always recommend at least a fiduciary. Certified financial planners are great. Obviously, bringing in a tax professional is a good thing as well. But when you're dealing with a tax professional, a lot of times they're very isolated on that one island. So I don't want you to only have a tax professional. You also want to work with a financial advisor that can help you look at the big picture over the next 10 or 20 years and maybe even some legal help as well, depending where you're at when it comes to estate planning. But you want to bring that all together so that you have a good comprehensive strategy that is accounting for not only current tax rates, future tax rates, possible moves, and then year to year. Look at this political environment. It is quite insane. This is a strategy that's not really a set it and forget it either. You're going to have to update this and manage that year to year. So getting somebody who trusts in your corner is a very smart move and can really pay dividends if you have a good advisor in your corner. So that being said, that's what I have for you today. I am going to throw up my website here if you'd like to have some help, okay? You can go to keepitsimplefinancial.com/talk. We offer a complimentary 45-minute to 1 hour consultation to help you map out the big items that you should be considering when it comes to your retirement planning. We will talk about potential Roth conversions if you might be a good candidate for that. But there's also a lot of other items that are coming into play. When to take pensions, when to take Social Security, your tax-efficient distribution plan for your retirement accounts, looking at inheritance or passing on money, things like that. Being able to spend comfortably early in retirement, so safe withdrawal rates. All these things are very, very important, and I highly recommend everybody has at least a basic retirement plan in place so that they have an idea and they're not leaving money on the table. That's one thing that we're seeing a lot of, that we have folks that follow these old rules of like the 4% rule, and they end up with way more money than they need, and now they're too old to spend it and really enjoy it at that time. So having a dynamic strategy and really mapping this out prior to you going to retirement, or at least in the early years of retirement, if you're already retired, can add so much more value, give you so much more life. And as things open up, hopefully here in 2021, as we get a vaccine going, you can get back to enjoying the things you want to do and not end up with too much money left over that just all goes to your kids and potentially gets a bunch of taxes paid out of it later. So we don't want that. So other than that, folks, I'm going to wish you a wonderful afternoon, a wonderful day, and we will see you on the next one, okay? Have a good one. If you need some help, book a call. I'm going to put the website in the comments as well, and we appreciate you watching. Have a great day. Bye-bye now.